Most traders believe that success in the markets comes down to having the right strategy, perfect timing, or insider information. They spend years searching for that one system, that one pattern, or that one mentor who will finally reveal the secret. But the truth is far simpler and much harder to accept. The real game is not played on the charts, it's played in the mind. The market doesn't reward intelligence, prediction, or even experience. It rewards consistency, and consistency doesn't come from knowledge, it comes from emotional balance. When you understand how your beliefs, fears, and expectations shape your decisions, you begin to see why most traders lose. It's not because they can't analyze the market, it's because they can't manage themselves in the face of uncertainty. Every trade you make exposes what you really believe about risk, control, and possibility. If your mind isn't aligned with the market's nature, its randomness, its neutrality, its lack of structure, then you will always find yourself fighting it and losing. The market has no agenda. It doesn't care if you win or lose. It doesn't punish you for being wrong, nor does it reward you for being right. It simply reflects the collective behavior of millions of participants acting on their own beliefs. The irony is that most traders take it personally. They treat losses as failures, wins as validation, and randomness as unfairness. That emotional attachment creates instability. It keeps you reacting instead of responding, hoping instead of executing, and fearing instead of observing. Simplifying trading psychology begins with one shift: separating your identity from your outcomes. The market doesn't know who you are. It doesn't owe you a profit, nor does it seek to humble you. The only constant you can control is your own perception. When you accept that the outcome of any single trade is uncertain, yet the outcome over a series of trades can be predictable. If you execute with discipline, you stop needing to be right. And the moment you stop needing to be right, you start to think in probabilities, not predictions. Trading with this mindset frees you. You no longer feel the emotional roller coaster of fear and euphoria. You begin to act objectively, not react emotionally. You start to trust the process, not the result. Every loss becomes feedback. Every win becomes data. You realize that trading isn't about outsmarting the market. It's about mastering yourself. The simplicity lies in understanding that your edge is not the system you trade. It's the state of mind you bring to it. When you can remain calm, confident, and consistent under pressure, your actions align with your intentions. That's when you stop chasing certainty and start operating within it, because the market doesn't create your emotions. It merely reveals them. And once you can see that clearly, trading stops being a battle and becomes a reflection of balance. The market reflects your psychology, not your strategy. Most traders enter the market with the belief that success comes from technical knowledge, perfect analysis, or advanced systems. They spend countless hours mastering indicators, learning price action, and following experts who promise consistent profits. Yet, despite all this effort, they continue to lose. They change strategies, switch time frames, and tweak entry rules, hoping to fix what they think is a technical problem. But what they fail to realize is that the real issue isn't on the chart, it's within their own mind. The market doesn't beat you because your system is wrong. It beats you because your beliefs, fears, and emotions influence every decision you make, often in ways you don't even notice. Every chart, every candle, every tick of price movement is neutral. It carries no inherent meaning until you assign one to it. When you look at a setup, what you see isn't the market. It's a reflection of your expectations, your hopes, and your fears. A trader who just took a loss might see the same setup as dangerous, while another who just had a win sees it as opportunity. The market hasn't changed. Only the lens through which it's being viewed has. That's the essence of trading psychology. Your interpretation of market information determines your behavior, and your behavior determines your results. When you operate from fear, you see threats where none exist. You hesitate on valid setups, cut profits short, or move stops out of panic. When you operate from greed, you overleverage, chase price, and ignore risk management. And when you operate from ego, you refuse to accept losses, forcing trades to prove you're right instead of protecting your capital. These emotions, fear, greed, ego, aren't external forces, they're internal reactions. The market simply acts as a mirror, reflecting them back to you with ruthless clarity. That's why two traders can look at the same chart, trade the same system, and end up with opposite results. The difference isn't the method, it's the mindset. One follows their plan calmly, accepting losses as part of the process. The other gets trapped in emotional cycles of hope and regret. The market rewards the trader who can stay objective, because objectivity leads to consistent execution, and consistency is what transforms randomness into probability. Think about it. Every trade is just one event in a series of many. The outcome of a single trade is meaningless on its own. But most traders can't see it that way. They treat each trade like a personal test of intelligence or skill. If they win, they feel confident. If they lose, they feel defeated. This emotional attachment creates instability. It prevents them from thinking clearly and following their edge over time. The market doesn't punish them, their own reaction does. When you look at the market through the lens of your own psychology, you begin to notice patterns not just in price, but in your behavior. How often do you enter too early because you fear missing out? How often do you exit too soon because you fear giving back profits? How often do you hold on to losers because you can't accept being wrong? These repetitive behaviors reveal that trading isn't about predicting the market. It's about managing your internal responses to it. If you change your strategy without changing your mindset, you'll keep getting the same results. You'll repeat the same emotional mistakes, only with different tools. You might convince yourself that the new method is the one, but eventually your fear, impatience, or self-doubt will surface again. The problem isn't the method, it's how you interact with it. Your mindset determines how effectively you can execute any system, and that's why the market reflects who you are, not what you know. A trader with a balanced psychology sees the market as an environment of opportunity. They don't feel threatened by uncertainty because they've accepted that uncertainty is part of the game. They don't attach emotional meaning to individual trades because they understand that profitability comes from long-term probabilities, not short-term outcomes. They can take a loss and move on, not because they don't care, but because they've detached their identity from the result. On the other hand, a trader who hasn't developed this psychological stability will interpret every fluctuation as a personal message. A small drawdown becomes a crisis. A minor win inflates their confidence. They get trapped in a constant emotional loop, high on wins, crushed by losses. The market doesn't care either way, but they project their emotions onto it, creating the illusion that the market is punishing or rewarding them. In reality, the market is doing what it always does, moving according to collective behavior, unaffected by anyone's feelings. This is why trading can be the most brutally honest teacher. It reveals your deepest insecurities and most hidden biases. If you're impatient in life, you'll be impatient in trading. If you avoid discomfort, you'll avoid taking losses. If you crave control, you'll try to predict the market instead of adapting to it. The market will always expose whatever you haven't mastered internally. Every mistake becomes a reflection of your mental state, not your strategy. To truly simplify trading psychology, you must start seeing the market as a mirror. It shows you what's inside you, your beliefs about risk, success, and worth. When you lose, the pain isn't from the loss itself, but from what you make it mean. Maybe it means you're not good enough, or that you'll never make it, or that you failed again. But those interpretations come from you, not from the market. Once you separate your emotional identity from the outcome of trades, you begin to experience freedom. You stop fighting the market and start understanding it as a neutral field of probabilities. A calm trader can see opportunities where others see danger. A fearful trader will see danger where none exists. The market reflects back exactly what you bring to it. If you bring fear, it will appear volatile and hostile. If you bring confidence grounded in self-awareness, it will appear full of patterns and possibilities. This is why developing your psychology is the most powerful form of strategy. Without it, no system will ever work consistently. Every price movement, every trade, every moment of hesitation or impulse, these are signals not from the market, but from your internal world. The goal isn't to eliminate emotion, but to understand it so deeply that it no longer controls you. When you reach that state, your strategy, however simple, becomes effective because your execution becomes consistent. And the market, in return, mirrors that consistency back to you through steady results, confirming once again that what you experience in the market is only an extension of who you are. Consistency comes from emotional balance, not knowledge. Every trader begins their journey by chasing information. They collect strategies, learn technical indicators, read countless books, and follow market experts. They believe that the more they know, the better they'll perform. Knowledge gives them confidence, but it's a fragile kind of confidence, one that disappears the moment the market behaves unpredictably. They soon discover that no amount of information can protect them from themselves. When fear, greed, or doubt take control, even the most advanced knowledge becomes useless. Consistency isn't about knowing what to do, it's about doing what you know without emotional interference. A trader can have the best system in the world, but if they can't execute it with discipline, it will fail. Emotional imbalance turns logic into confusion. After a few losses, fear takes over, and they hesitate to take the next setup, even if it perfectly fits their rules. When a few wins come, greed takes over. leading them to overtrade or increase position size impulsively. In both cases, emotion distorts perception. The trader starts reacting to feelings, not facts. Knowledge remains in the background silent because emotional noise drowns it out. This cycle continues endlessly. Confidence on wins, anxiety on losses, euphoria on profit streaks, despair on drawdowns. The trader mistakes emotional volatility for market volatility, unaware that it's their own imbalance causing inconsistency. True consistency begins when emotions stop dictating behavior. That doesn't mean emotions disappear, they never do, but they no longer influence execution. Emotional balance allows a trader to follow their plan the same way after a loss as they would after a win. It creates stability, and stability is what turns probability into profitability. Without emotional balance, even the best trading system is doomed to inconsistency because every decision becomes reactive. When a trader's mood changes with every trade, their results will fluctuate in the same way. Knowledge is intellectual. It can be studied, memorized, and explained, but balance is emotional. It must be experienced. You can't learn emotional control from a book or a video. You develop it through awareness, reflection, and repetition. You start noticing how you feel before, during, and after trades. You begin to identify the triggers that cause impulsive decisions. Maybe it's the fear of losing money, the desire to recover from a bad trade, or the urge to prove yourself right. Each emotion carries a story you tell yourself about what trading means to you. As long as those stories remain unexamined, they control you. Once you bring them to light, you start to gain freedom from them. Emotional balance is the ability to stay centered regardless of what happens in the market. When the market moves against you, you remain calm enough to follow your stop-loss rule. When it moves in your favor, you don't become greedy and abandon your plan. You stop measuring your self-worth by your last trade's result. You understand that a loss doesn't mean failure and a win doesn't mean mastery. You see both outcomes as part of a larger statistical process. That perspective is the foundation of consistency. It transforms trading from an emotional battlefield into a structured practice of execution. Many traders know what a good setup looks like, but they can't take it when it appears. Their mind creates hesitation, doubt, or second guessing. They start analyzing more data, waiting for extra confirmation, or looking for reasons not to act. This is not a lack of knowledge, it's emotional resistance. The trader doesn't trust the process because they don't trust themselves. When they finally take the trade and it loses, the pain reinforces the hesitation even more. When it wins, it reinforces overconfidence. Both outcomes feed the emotional loop that keeps consistency out of reach. Balancing emotion doesn't mean suppressing it. Suppression leads to denial, and denial leads to impulsive behavior later. Emotional balance comes from acceptance. You acknowledge fear without letting it paralyze you. You accept greed without letting it control you. You see excitement without letting it cloud judgment. You watch disappointment without letting it damage your confidence. By allowing emotions to exist without reacting to them, you weaken their power. You begin to act based on principle, not impulse. The difference between a consistent trader and an inconsistent one isn't in how much they know. It's in how stable they are under pressure. The consistent trader treats each trade as just another execution of their plan. They don't need to win to feel good. They don't need to avoid losing to feel safe. They trust the probabilities because they trust themselves to act consistently. Emotional balance gives them that trust. It allows them to remain unaffected by short-term outcomes. They understand that success in trading isn't built from individual trades, but from a series of disciplined actions repeated over time. When a trader achieves emotional balance, uncertainty no longer feels threatening. Most people try to eliminate uncertainty by predicting the market, but prediction is an illusion of control. The balanced trader doesn't seek control over the market. They seek control over their responses to it. They accept that they can't know what will happen next, yet they act with confidence because their edge lies in probabilities, not certainties. That mental shift changes everything. Instead of fearing randomness, they embrace it. Instead of reacting to emotions, they observe them. The market becomes a neutral environment, not an emotional storm. Knowledge without balance leads to self-sabotage. You might know where to enter, where to exit, how to size positions, but none of it matters if you can't follow through. Knowledge is potential, balance is execution. The mind that is emotionally unstable will always find ways to override logic. You'll convince yourself that this time is different, that the market feels right, or that you can recover the loss. These justifications are signs of emotional imbalance, not strategic adaptation. The balanced trader never argues with the market. They accept what is and respond with discipline. Emotional balance also creates resilience. Trading will always involve drawdowns, uncertainty, and losing streaks. Without emotional stability, those moments destroy confidence. The unbalanced trader gives up, changes systems, or starts trading recklessly to recover. The balanced trader endures the same conditions but stays grounded. They understand that temporary setbacks don't define long-term performance. This resilience keeps them in the game long enough for their edge to manifest. Knowledge might make you aware of what to do, but only emotional balance allows you to do it consistently. Consistency is not a product of analysis. It's a state of mind. It's the ability to remain emotionally neutral while making decisions under uncertain conditions. It's performing the same way whether you're winning or losing, whether the market is calm or volatile. The trader who can maintain that state doesn't need to seek confidence externally. Their confidence comes from knowing they will always act in alignment with their plan, no matter what the market does. The real test of a trader's growth is not how much they know about the market, but how well they can control themselves when it matters most. The charts reveal patterns, but the mind interprets them. Emotional balance ensures that your interpretation remains objective. It keeps you from turning temporary fluctuations into personal judgments. The market stops feeling like an opponent and starts functioning as an arena for practicing discipline. When you reach that point, consistency becomes a natural result of your inner equilibrium. Detach your identity from trading outcomes. Most traders enter the market with the idea that their results define their worth. A winning trade makes them feel intelligent, capable, and successful, while a losing trade leaves them feeling frustrated, inadequate, or even ashamed. This emotional attachment creates a dangerous connection between performance and self-image. When you begin to see trading results as a reflection of who you are, you lose the ability to stay objective. Every market fluctuation becomes personal. Every loss feels like a wound to your ego, and every win feels like validation of your value. The truth is that trading is not a test of character, intelligence, or self-worth. It is simply a process of managing probabilities within uncertainty. The market is indifferent to your feelings. It does not know your name, your background, or your goals. It only reflects behavior. When your sense of self becomes tied to the outcome of trades, you lose emotional balance. You become overly attached to being right. You stop thinking in terms of probability and start seeking certainty. You may hold on to losing trades, hoping they turn around, because accepting a loss feels like admitting failure. You may double down on a bad position just to prove yourself correct. This attachment transforms trading from a game of discipline into a battle of ego. The need to protect your identity overrides your need to protect your capital. You're no longer trading the market. You're trading your self-image. Every trader experiences losses. The difference lies in how they interpret them. A detached trader sees a loss as a cost of doing business, as one of many possible outcomes. They remain calm because their self-worth isn't on the line. An attached trader, however, interprets the same loss as a threat to their identity. They react emotionally, often trying to make up for it immediately. They may enter revenge trades or abandon their strategy altogether. The more they tie their value to results, the more unstable their decision-making becomes. The market, being unpredictable, inevitably produces outcomes that hurt their ego. And so the cycle of emotional volatility continues. Detachment doesn't mean indifference. It doesn't mean not caring about performance. It means you no longer take outcomes personally. You can care deeply about your process, your growth, and your consistency without attaching those things to who you are as a person. When you separate your identity from the results, you gain freedom. You stop fearing losses because they no longer threaten your self-image. You stop chasing wins because they no longer define your worth. You start to focus purely on execution, the only part of the process you can truly control. The human mind naturally seeks validation. From childhood, we're conditioned to associate success with approval and failure with shame. This conditioning follows us into trading. We look for winning trades to feel successful and losing trades to feel defeated. But the market doesn't reward emotional neediness. It punishes attachment. The moment you need a trade to work, you're already at a disadvantage. Need creates fear, and fear clouds perception. Detachment removes that need. You can observe price action without emotional distortion because the outcome doesn't define you. A detached trader is free to follow their plan without hesitation. They execute trades based on predefined rules, not on emotional impulses. If a trade wins, they record it and move on. If it loses, they do the same. There's no emotional swing, no overreaction, no need to compensate. Each trade becomes just another event within a series. Over time, this mental neutrality builds consistency. Detachment creates clarity, And clarity allows for precision. Ego thrives on being right. It fears being wrong more than it fears losing money. This is why many traders break their rules. They can't emotionally tolerate being wrong. Detachment neutralizes this fear because it separates your self-image from your decision-making. When you're detached, you can accept being wrong without feeling damaged. You understand that every trader, no matter how skilled, will experience losing trades. Being wrong on a single trade doesn't mean you're a bad trader. It means you're human. Trading is not about proving anything to anyone. Yet most traders subconsciously trade to confirm their self-image. They want to feel smart, competent, or in control. The market exposes this illusion. It doesn't allow you to hide behind false confidence. Every weakness, impatience, fear, arrogance gets revealed. Detachment forces you to confront these parts of yourself without judgment. You start to see that trading isn't about winning, it's about self-awareness. When you stop defending your identity, you can start improving your process. Many traders think emotional pain comes from losing money, but it doesn't. The pain comes from what you make that loss mean about you. If you lose a trade and immediately feel frustration or shame, it's because you've tied the result to your self-image. Detachment breaks this link. It allows you to experience losses as neutral data points, not personal failures. When you reach that state, your emotional energy stays consistent. You no longer waste it on regret or self-blame. Instead, you channel it into analysis, review, and growth. The process of detachment starts with awareness. You begin by noticing how your emotions react to each outcome. Do you feel elated after a win? Do you feel anxious after a loss? Those reactions reveal where your identity is still entangled with trading. As you become more conscious of these patterns, you can start to separate the event from the interpretation. A loss is simply a trade that didn't work. A win is simply one that did. Neither defines you. This mental shift might sound simple, but it transforms the entire way you relate to the market. Detachment also eliminates performance anxiety. When you stop equating results with identity, you no longer fear taking trades. You don't hesitate to act on your edge because you're not worried about how the outcome will make you feel. This creates flow, the state where you execute naturally and effortlessly. You're fully engaged but not emotionally attached. You can take losses gracefully, adjust when needed, and stay disciplined without forcing control. Traders often believe that the pain of losses will disappear once they get better or more profitable, but even successful traders who haven't detached their identity still suffer emotionally. Their fear simply shifts from losing money to losing their status or reputation. Detachment removes this problem completely. When your identity is no longer tied to outcomes, your emotional stability remains intact regardless of performance. You can handle big wins and big losses with the same calmness because neither touches who you are at your core. The market constantly tests emotional resilience. It exposes ego, fear, greed, and attachment in every movement. Detachment doesn't mean you stop feeling these emotions. It means you stop identifying with them. You observe them as passing states instead of truths about yourself. You realize that a trade can fail without you being a failure, and a trade can succeed without you being superior. Each trade becomes feedback. Nothing more, nothing less. That mindset allows for continuous improvement because you're no longer defending anything internally. When you reach the point of true detachment, trading becomes clearer and more fluid. You stop overanalyzing. You stop reacting emotionally. You start following your process with confidence rooted in neutrality. The market stops feeling like a place of danger and starts feeling like a field of opportunity. Every outcome becomes information. Every fluctuation becomes feedback. You no longer need to win to feel worthy, and you no longer fear losing as a threat to your identity. You act not to prove, but simply to perform. Think in probabilities, not predictions. Most traders enter the market with the illusion that success comes from knowing what will happen next. They analyze charts, study indicators, and interpret patterns as if they could uncover the future. This desire to predict is natural. The human mind seeks certainty in an uncertain world, but the market doesn't operate on certainty. It operates on randomness and probability. Every price movement is the result of countless decisions made by thousands of participants, each reacting to their own emotions, beliefs, and information. No one can control or accurately forecast that collective behavior, yet traders continue to act as if the market must obey their analysis. The constant search for certainty creates frustration, hesitation, and emotional exhaustion. The ones who break free from this illusion and start thinking in probabilities experience a complete shift in how they trade and how they feel. Thinking in probabilities means accepting uncertainty as a permanent condition of the market. It means recognizing that no setup, no signal, and no pattern guarantees a result. You can have a system that works 60% of the time and still lose if your mindset demands to be right on every trade. The moment you expect certainty, you set yourself up for emotional pain. A loss feels like failure, a win feels like confirmation, but in reality, both are simply outcomes within a series of random events governed by probability. When you start to think this way, each trade becomes just one part of a larger picture. You no longer evaluate success by what happens in one trade, but by how you perform across many. Traders who think in predictions constantly seek to avoid being wrong. They spend endless time analyzing, waiting for perfect confirmation, trying to eliminate risk. But risk is never eliminated. It is managed. Thinking in probability shifts focus from trying to be right to managing exposure and execution. It's about playing a statistical game rather than an emotional one. Each trade is like flipping a weighted coin. You might lose a few flips in a row, but if your edge is real and your discipline consistent, the probabilities will work in your favor over time. Predictive thinking tries to win every flip. Probabilistic thinking focuses on playing enough flips to let the odds play out. The transition from prediction to probability requires a change in belief. Most traders secretly crave control. They want the market to behave according to their analysis because control feels safe, but the market isn't a controlled environment. It's fluid, dynamic, and uncertain. Probability thinking acknowledges that you can never know what will happen next, but you can always know how you'll respond. That's where real control lies, not in the outcome, but in your reaction. Once you internalize this, you stop feeling anxious before placing a trade because you've accepted that uncertainty is part of the process. You're no longer fighting market, you're cooperating with it. In probability-based thinking, losses are expected and accepted. They don't trigger emotional responses because they're already accounted for in your mindset. You understand that even with a strong edge, losses are a cost of doing business. Just as a store expects certain overhead costs, a trader expects losing trades. The goal isn't to avoid them, but to ensure that losses remain smaller than wins over time. This mental shift transforms trading from a reactive activity into a strategic process. You begin to act consistently, not out of fear or hope, but out of logical understanding. Probability thinking also removes the illusion of patterns as guarantees. Patterns, indicators, and signals are simply representations of recurring tendencies. They provide an edge, not certainty. When traders misunderstand this, they treat every signal as a promise and feel betrayed when it fails. But when you think in probabilities, you know that even the best setup can lose, and that doesn't make it wrong. It just means that this time, probability didn't favor you. That understanding frees you from emotional swings. You no longer see losses as punishment or wins as reward. They're both expressions of randomness within an expected range of outcomes. When you stop predicting, you also stop resisting the market. Prediction-based traders often try to force the market to fit their expectations. They hold losing trades longer because the market should turn soon. They exit winning trades early because the market might reverse. Their actions are driven by attachment to an imagined outcome. Probability-based traders, in contrast, act without attachment. They take trades according to their edge, accept whatever result comes, and move on to the next opportunity. This detachment creates mental clarity and emotional stability. Another important aspect of thinking in probabilities is understanding variance. Even with a solid system, you can experience streaks of losses or clusters of wins. Variance is not evidence that your system is broken. It's simply a natural occurrence in any probabilistic process. Traders who don't understand this get discouraged after a few losing trades and change their system prematurely. Those who think in probabilities remain unaffected because they know that short-term fluctuations don't alter long-term expectancy. They trust the process because they trust the math behind it. Probabilistic thinking also influences risk management. If you accept that any trade can lose, you size your positions accordingly. You never risk more than you can emotionally or financially tolerate. This allows you to stay in the game long enough to let your edge manifest. Predictive traders often risk too much because they believe they've found the perfect setup. When that trade fails, it not only hurts their account but also their confidence. Probability-based traders never assume certainty. They prepare for every possible outcome. This preparation creates confidence rooted in realism rather than optimism. The emotional benefits of thinking in probabilities are profound. Anxiety fades because you're no longer desperate to be right. Regret diminishes because you understand that a losing trade was simply one possible result. Euphoria after wins softens because you know it doesn't make you invincible. Your emotional state stabilizes because your expectations align with market reality. You no longer judge yourself by individual outcomes, but by how consistently you execute your plan. This mindset transforms trading into a calm, focused practice rather than a chaotic, emotional ride. When you embrace probabilities, you begin to see the market as neutral. It's not against you or for you, it just moves. Every tick represents opportunity, not threat. You stop assigning personal meaning to market behavior. You become an observer, not a predictor. This detachment doesn't make you passive, it makes you precise. You're no longer reacting to the need for certainty, but responding logically to what the market presents. This is how professional traders operate. They don't try to guess the future. They manage the present with discipline. The irony is that when you stop trying to predict, your accuracy improves. You start to recognize high probability situations without overanalyzing them. You execute more cleanly, manage risk more effectively, and allow winning trades to run because you're no longer emotionally tied to specific outcomes. You understand that one trade doesn't define anything. It's just data in a sequence. You become statistically driven instead of emotionally driven. Most traders fail not because they lack technical skill, but because they refuse to accept uncertainty. They want to believe that knowledge can eliminate randomness. It can't. What knowledge can do, however, is help you understand where probabilities lie. Once you accept that all trading decisions exist within uncertainty, you shift from needing to be right to needing to be disciplined. You stop measuring success by accuracy and start measuring it by consistency. This is the true essence of probability-based thinking. It turns trading from a guessing game into a structured process of execution under uncertainty. Mastering yourself is the real trading edge. Every trader begins by searching for an external advantage. They look for indicators, strategies, mentors, and patterns that promise consistent profits. They believe success is hidden in some secret formula the professionals use. But after months or years of chasing new systems, they eventually realize that every method works for someone and fails for someone else. The difference isn't in the method. It's in the trader. The person behind the strategy determines its success or failure. The market doesn't reward intelligence, prediction, or even experience. It rewards discipline, emotional stability, and self-control. Mastering yourself becomes the ultimate edge because it determines how you think, feel, and act under pressure. The market is a mirror. It reflects your mindset, your beliefs, and your emotions back to you through your results. If you're patient, disciplined, and objective, your trades will reflect that. If you're fearful, impulsive, or greedy, that will appear in your performance. Most traders lose not because their strategy is weak, but because they can't follow it with consistency. They violate their own rules, chase trades, and act on impulse. They know what to do but can't make themselves do it. That gap between knowledge and behavior is the space where self-mastery decides everything. Without mastering yourself, you'll always be your own biggest obstacle. Self-mastery in trading begins with awareness. You must learn to observe yourself just as carefully as you observe the market. Every hesitation, every impulse, every emotional reaction is a clue to your internal state. You start to notice patterns. The fear that makes you exit early, the greed that makes you overtrade, the anger that pushes you to take revenge trades. These emotions don't come from the market, they come from within you. When you understand that, you stop trying to fix the market and start working on yourself. Self-mastery is not about controlling the market, but about controlling your response to it. A trader who masters themselves doesn't need perfect conditions to perform. They operate consistently in any environment because their decisions come from discipline, not emotion. They don't allow fear to paralyze them or greed to blind them. They can take losses without frustration and wins without arrogance. Their focus remains steady because their confidence isn't tied to short-term results. This kind of mental stability gives them a powerful edge. While others are reacting emotionally to every fluctuation, they remain calm and execute their plan with precision. Self-mastery requires emotional regulation. The market constantly triggers emotions because it involves money, uncertainty, and risk, all powerful psychological forces. Every price move creates an opportunity for emotional imbalance. When prices move against you, fear and panic arise. When prices move in your favor, excitement and overconfidence surface. Without emotional control, these reactions dictate your actions. You end up buying when you should sell, holding when you should exit, or sitting out when you should engage. Emotional awareness allows you to pause, observe the feeling, and act according to your plan rather than your impulses. The disciplined trader understands that emotional impulses are temporary. They recognize that the urge to exit early or double down on a position is just the mind's reaction to discomfort. Instead of obeying that reaction, they acknowledge it and continue following their rules. This ability to act independently of emotion defines mastery. It's what separates professional traders from emotional ones. The professional has trained their mind to remain objective in situations that make others irrational. They've developed habits that keep them aligned with their plan, even when their feelings tempt them to deviate. Self-mastery also involves detachment from outcomes. When you stop needing to be right or fearing to be wrong, your actions become purely procedural. You take trades because your system signals them, not because you want to prove something. You exit trades because your plan requires it, not because your emotions dictate it. Detachment doesn't mean you don't care. It means your self-worth doesn't depend on the results of individual trades. This mental independence keeps your judgment clear and your reactions steady. To master yourself, you must also understand your beliefs about money, risk, and success. Many traders carry hidden emotional attachments to these concepts. Some fear losing money so deeply that they avoid taking trades altogether. Others associate risk with danger instead of opportunity. Some trade to escape feelings of inadequacy, seeking validation through profits. These unconscious motivations control behavior until they're brought into awareness. Self-mastery requires you to confront these internal narratives and replace them with beliefs that support rational trading. You must learn to see risk as necessary, losses as normal, and uncertainty as opportunity. Consistency in trading is not a result of talent, but of habit. Habits are formed through repetition, and repetition requires discipline. A self-mastered trader has developed habits that reinforce stability. They plan every trade, manage every risk, and review every result. They don't rely on emotion or guesswork. They rely on process. This level of discipline creates predictability in performance, even in an unpredictable environment. While most traders swing between extremes of overconfidence and doubt, the self-disciplined trader remains balanced because their focus is on execution, not outcomes. Mastering yourself also means managing your expectations. Unrealistic expectations create emotional pressure. When you expect every trade to win or every week to be profitable, you set yourself up for disappointment. That disappointment leads to impulsive behavior as you try to force results. The trader who masters themselves accepts that uncertainty is part of the process. They focus on controlling what they can, their risk, mindset, and actions, and let go of what they can't. This acceptance creates peace of mind even in volatile markets. Another aspect of self-mastery is patience. Most traders fail because they can't wait. They want immediate gratification, instant confirmation, and quick profits. The market rewards the opposite. Patience allows you to wait for high-quality setups, to hold winning trades longer, and to stay out when conditions aren't favorable. It's one of the hardest skills to develop because it requires emotional maturity. Impatience is a symptom of emotional immaturity, a desire to control time and outcomes. Patience reflects inner calm, trust in your edge, and confidence in your process. Self-mastery is also about self-trust. You must learn to rely on your own discipline rather than external signals or emotional impulses. Most traders don't trust themselves because they've broken their own rules too many times. Every time you act impulsively, you weaken that trust. Every time you follow your plan despite discomfort, you strengthen it. Over time, this trust becomes confidence. Not the fragile confidence that comes from wins, but the deep, stable confidence that comes from integrity. When you trust yourself fully, you don't need the market to validate you. You operate from internal certainty rather than external approval. The process of mastering yourself is ongoing. You don't reach a point where emotions disappear or discipline becomes effortless. The challenge remains, but your ability to handle it grows stronger. You learn to recognize when your emotions are influencing you. You learn to pause before reacting. You learn to treat trading as a mental exercise rather than an emotional struggle. Each experience, win or lose, becomes part of your growth. When you master yourself, you stop looking for shortcuts or magical systems. You realize that the real battle has always been internal. The charts, indicators, and strategies are tools, but you are the operator. How you think, feel, and act determines how those tools perform. The traders who last are not the ones who find the perfect method. They are the ones who master their mind, the ones who stay calm under pressure, disciplined under temptation, and objective under uncertainty. Gain the ultimate advantage because they can execute consistently in any market condition.